Hi everyone, so hopefully by now you've taken a look at the chart of accounts list, and it sort of makes sense with the readings and then the PowerPoint, the debit and credit PowerPoint. It made sense. The key thing to keep in mind is that certain accounts worked in certain ways. You have 5 major categories of accounts. If we go back and look here, let's just take one step back here. And you go to this here, this key thing really shows you. Double entry accounting means that for every debit you must have an equal credit. And the accounts operate in different ways. We have the assets, liabilities, equity, and then we have the other good accounts that we have is revenues and expenses. They're the 5 main categories of accounts, and they all operate in other ways, which is what that one sheet showed you. So taking a look there, printing that out, keeping that by your side every time you work on the accounting stuff really will help. This chart of account rules is the one that really lists where everything is. As you got through the debit and credit PowerPoint slide, you should have noticed that we started to journalize transactions. So the way the process works is you read a transaction, you pick what account from the chart of account is affected by the transaction, and then you journalize it from there. And we're going to show you some demonstrations like that. By looking at the main thing you want to look at now is you want to open up the file I just posted, which is called Journal Entry Demonstrations. And this brings us back to our Smart Touch learning. And the first 3 were done for us, but I'm going to show you again how to do them. So transaction number 1 shows the owner contribution was the name of the transaction. Sheena Bright contributes $30,000 cash to Smart Touch Learning in exchange for stock. The effect of the transaction on the equation is, so basically we're looking for what do we debit, what do we credit here. So we have to think about it. What 2 accounts from the chart of accounts, or more than 2, which accounts are affected by this? So hopefully you're seeing that what's happening here is that the company is getting cash, and for that they're giving up common stock. So the 2 accounts, and we'll just make a cheat sheet on this piece of paper here. The 2 accounts being affected are cash and common stock. Next, we want to look, how are those accounts being affected? Well, is cash going up or down? So cash is going up, and common stock is going up. Both of them are going up because before this, they had nothing in their accounts. So the effects of them is that they're now increasing. So we go back to our chart, the chart of account rules, and you look to see what's listed. So I got cash here, and it's going up, so that's a debit. And then I look at common stock, that's going up, so that's a credit. The blank spots are just the opposite. So it's up for debit, down for credit, and so on and so forth. If the box is empty, it means to go down. So in both of these, I have a cash that is debit and common stock as a credit. So take out the journal entries that you printed, that sheet that I asked you to print, and we're going to start by tracking this down. So this sheet looks something like this. You probably have a printed one. Okay. And you're going to start by writing, let's just say this happened in November. And we'll say November 1st. So right there in that box, you write November 1st. The rules with journalizing transactions is the debit account always gets listed first. So we're going to do here cash, and the amount was $30,000, so you're going to go over. Here you have 2 columns. The first column is your debit column, the left side. The right side is your credit column. So let's do the debit. We're going to do $30,000. And that's done. So we debited cash $30,000. Next, we're going to credit common stock. So when you list the credit, you always go down to the next line, and you always indent a few spots. This makes it easier to read. And then the amount is then $30,000. And as you can see, we have a debit for $30,000 and a credit for $30,000. So that means we have a balanced equation. Then you always want to make a note. This was sale of stock. And then that's it. So you've journalized the transaction. And that's all you need to do. Let's go to the next one. In the next one, we purchased land for an office location, paying cash of $20,000. So let's take a look. I got our cheat sheet here. So in the next transaction, we have cash is being affected because that's listed, and land. This time though, our cash is going down, so we're going to put a negative there. But our land is going up. If we go back to our chart, we find cash here, and look at that. We don't have land, so you might want to add land in that chart. I guess I missed land there. So type in land. Land is also an asset. I forgot about that account. Okay. So we have cash and land, both assets. Land is going up, cash is going down. That's okay, that works for our debit and credit. So let's just say November 2nd. Since I already have the November there, I'm just going to skip a line, put in a 2. This time land is my debit, and it's for $20,000. And I have cash as my credit for $20,000. And we purchase land. Always want to put a reason in. Okay. All right. Let's go back. Let's do transaction number 3. In this one, Smart Touch Learning buys office supplies. So hopefully you're getting the gist. You go back, you look. This time they didn't pay cash, they bought it on account. So account creates, on account means for credit. So that creates a debt that we owe. So we'll call that debt accounts payable. The amount's $500. Well, office supplies is an asset going up. So I'm going to put November 5th. I'm going to debit office supplies, because that's an asset going up. And over here it's going to be for $500. And then my credit liability accounts payable is a liability, which when that goes up, it's a debit. It's a credit, I'm sorry, for $500. So accounts payable is a credit for $500. And we purchased office supplies on account. Okay. So hopefully you're getting the idea here. The fourth one tells us that we provided service for clients. Well, service for clients is a revenue. We're receiving money and they paid us cash. So let's go November 10th. We received cash for $5,500. And we performed service. So service revenue, since revenue is the income we earned, for $5,500. And this was provided service, we'll just put. So you can go back to, you can make the cheat sheet there if it helps you looking and finding the accounts, then see if it's going up or down, cross-referencing it. And at first, that's probably going to help you a lot. But eventually, it's all repetitive. Accounting is all repetitive. Transaction 5 is, this time we're doing service, but instead of them paying cash, they're giving us accounts receivable. So it's something that is owed to us in the future. But we record the service at the time of the event. Okay? So we performed the work, we did the service. So service revenue is going up. When service revenue goes up, it's a credit. Accounts receivable is an asset that's going up. So that's a debit. So I'm going to go November 12th, fill in accounts receivable. I always recommend you use pencil because there's always going to be times when you make mistakes. That was for $3,000. And service revenue is our credit. And that's also $3,000. Okay? And this time, we still provided service. But we should write on account this time, because now we know that that customer still owes us. Transaction 6 deals with the payment of expenses. So when you pay an expense, you're obviously losing cash, and that's a clue. If you know cash is affected in the transaction, is it going up or down? That clues you in, number one, what you should do with everything else. Since we're paying an expense, that means cash is going down. So we're losing cash. And how is it going down? 2,000 of it's going to rent, and 1,200 is going to salaries. So we're going to say November 15th. Okay, I'm on a debit rent expense for $2,000. And then I'm also going to debit salaries expense for $1,200. Now, on the credit side, I'm going to lose cash. Cash is going down, and it's going down the total amount. $2,000 and $1,200 is $3,200. And as you can see, we have 2 debits, but only 1 credit. That's okay because the amounts equal. $2,000 for rent, $1,200 for salaries, $3,200 for cash. Since the amounts equal, it doesn't matter that you have more debits than credits or vice versa. Transaction 7 is we are paying the store for the office supplies that we purchased up here. If you look, I just realized I made a mistake there. I wrote accounts liability and it should have been accounts payable. Again, good thing we have a pencil. Hopefully I said payable. Hopefully you have a pencil if you followed exactly what I wrote. It should be accounts payable, okay? It is a liability. But now we're paying on that. So we owed $500, and now we're paying $300. So we'll go here and we'll say November 20th. That's going to go down. So that's our debit. And over here, it's for $300. And to pay it, we're using cash. So that's $300. And we're making payment on the debt. I just noticed up here, I forgot to do what this was. I didn't say what the purpose was. So we'll just say payment of expenses. I try to skip lines because it makes it cleaner and easier to find things, okay? Similar transactions happen in number 8. This time, instead of us paying on an account, we're receiving on an account. So if you go back to on November 12th, we did service for $3,000 on account. Now that customer's paying us $2,000. So we're going to just say November 23rd. Okay. We're now getting cash for $2,000. And now they owe us less. So the amount they owed us, which was in accounts receivable, is going down $2,000. And this is a payment from customer. Our last transaction is payment of dividend to Sheena Bright for $5,000. So basically what happened here, the company made money. So in order to make the money, they're going to give that back to the owner. So we're going to pay them cash for $5,000. So cash is going down, so that's our credit. If you recall, we put I have an asterisk here next to dividends. Dividends is an equity account. The asterisk means it does the opposite. Okay? So since normally when it goes up, it's a credit in the equity account, but dividends is starred, you flip it. So it's a debit to dividends for $5,000, a credit to cash. If you go back to what I said before, if cash is involved in the transaction, it's always wise to list that first. Find out, is cash going up or down? And in this case, cash is going down, so you know that's a credit. Then you know what you need to do to the other transaction, which in this case is dividends, is going up, and that is a debit. And this is payment of dividends to owner. Or this could also be called distribution of profit, is another way to word payments to dividends, because that's what you're doing. You're distributing the profit to the owners. So this is your journal sheet. It's pretty self-explanatory. It's good to keep it neat, space it out. There's plenty of these on Canvas that you can print out. This is the first step in analyzing transactions. You have your general journal. If you look here, you have this empty box all right there. The empty box is because after you journalize something, you have to post it. For posting purposes, we're using the T accounts, also found on Canvas. Looks something like this. It's called a T account because it's here. For the T accounts, you list the account name on the main line, cash, and then as you look at it, it's debit and credit. Left side, right side. Debit's over here, credit's on the right. The idea is that you should go to each account. So right here we have cash, $30,000. So transaction number 1, we have cash, we have a debit of $30,000. So you go to your key account and you do $30,000 cash. Now we also have a credit to common stock. So let's create a new T account for common stock. Okay. And on this side, you do a credit for $30,000. One too many zeros there. Let's erase that last one. Then to make sure that you did it, you check there, you check there. You go through each transaction. Land is our next one. Start a new account for everything there. Put in your debits and credits as they are listed. Then check them off. Next we have office supplies. So this way you have all the accounts listed and you put in their debits and credits accordingly. The idea is that you're running a total of the accounts. You're running a balance. You're keeping everything set. Let's go through and just look at the cash. So here we have another cash on the 10th. It was a debit of $5,500. So let's put that one in. We have cash again here on the 20th. So this time that was a credit of $300. We have cash on the 23rd. That was a debit of $2,000. That was that customer that paid us. I missed this cash on the 15th of $3,200 that we paid out. Okay. Normally you would go in order, but I am just showing you the cash account to just see things going down. But checking off lets you see it. Okay? Then I have cash on the dividends, $5,000 that we paid. Yeah, you know what? Let's just finish them off. Okay? Let's go back to November 10th. We have service revenue, $5,500 credit. So I'm going to do service revenue, $5,500. I can check that one off. Oh, I missed the spot where that was checked. It should be below the cash. Okay, erase that a little bit better. On the 12th, I have accounts receivable and service revenue. Accounts receivable, $3,000. Service revenue, $3,000. Filling them in. Going back, checking them off. 15th, I have rent expense and salary expense. All right, did the cash. That's that one I initially missed, $3,200. I have rent expense here. And salaries expense. Rent was $2,000. Salaries was $1,200. Now that is done. Okay. I have my accounts payable on the 20th. That's now $200, $300 off. Accounts receivable is now a credit of $2,000. And I have to create one more T account for dividends. $5,000. As I do that, I then can go back and look, and I see that every box is checked. There's the last one for dividends. So now that means I've created my journal sheet. I then post it to my T accounts. From there, it's the end of the month. And what I want to do is I want to make a balance. So I would add up all these, 20,000, 25,000, 28,200, 28,500 on the credit side. I have 30,000, 35,500, 37,500 on the debit side. And then I'm going to find out my balance in cash. You always subtract the lower from the higher. Is $9,000. And it sits on the side that's the higher. So you always subtract the lower from the higher, and the balance stays on the higher side. So in this case, my debit side is highest. I subtract the balance, all the transactions in the credit side, and now I have a $9,000 balance in cash. We can look over here at accounts payable to see how it's the opposite. I have 500 in credit, 300 in debit. I'm going to draw a line. So I have a balance of 200 in credit for accounts payable. The goal is, after this, at the end of each month, you list down on something called a trial balance. So you would say it's a trial balance. And you would list all the accounts, cash, land. And if they have a balance, you would list it either the debit side or the credit side. And at the end, they would balance, because that's the accounting equation. There's more slides on this and how the trial balance works. Hopefully this demonstration gives you an idea of how to journalize transactions and then post them to the T-charts. There will be an assignment posted. Give you a couple days to look at that, where you get to try it on your own and answer some questions. Let me know if you need anything. Talk to you soon.